Looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. We have this first question from Tom. He asks, is it true that Republican presidents typically do better for the economy than Democratic candidates? Okay. The notion that Republican presidents are inherently better for the economy and stock market than Democrats is indeed a popular belief, but it's important to scrutinize the historical data. I mean, take Ronald Reagan, for instance. He presided over a period of robust economic growth and a strong stock market. However, George H.W. Bush followed. The economic landscape wasn't as favorable. Yet during Bill Clinton's presidency, despite initial concerns, the economy thrived and the stock market soared, benefiting many investors, including those in retirement, relying on their investments for income. Moving forward, the narrative shifts again during George W. Bush's administration, which began with promise but ended with significant market downturns, notably the dot-com bust and the 2008 financial crisis. Conversely, under President Obama, the stock market rebounded strongly following the Great Recession, showcasing a recovery that restored wealth for many investors. So, what can we conclude from these historical snapshots? It's clear that attributing market performance solely to the party in power oversimplifies a complex economic reality. Every president, regardless of political affiliation, aims for a strong economic or a strong economy because economic health is pivotal to their success and public sentiment. Voters too often prioritize economic prosperity when assessing presidential performance. Now, moreover, our governmental structure with its checks and balances means that no single branch or individual, including the president, can unilaterally dictate the economy's trajectory over a short term, such as a 4-year presidential term. Economic policies take time to implement and even longer to manifest their full effects, whether positive or negative. Now, how does this relate to investing for income in retirement? Well, regardless of who occupies the White House, retirees and investors need to focus on building resilient portfolios that can weather various economic cycles. So this means diversifying investments across asset classes, sectors, and geographic regions to mitigate risks and reduce volatility. Now, for income-focused investors in retirement, this strategy often includes allocating to, let's say, dividend-paying stocks, bonds, real estate investment trusts, and potentially annuities or other income-generating investments. Now, these assets can provide steady cash flow while offering some insulation against market fluctuations. So in essence, while political narratives around economic stewardship may sway public opinion, prudent financial planning remains paramount for retirees. So by staying diversified, focusing on long-term goals, and seeking professional advice when needed, retirees can navigate market uncertainties regardless of who occupies the Oval Office. Great question. As always, if you would like to send in your questions, you can do so. You can do so by emailing them to poollocke@poollocke.com. All right, jumping right ahead. Let's go to our second question. So our second question today is from Candace. And Candace asks, if I'm invested in dividend stocks, and those are in those sectors that are typically affected by politics, how do I know when to get out? All right, Candace, let's dive deeper into managing dividend stocks in politically sensitive sectors and how you can ensure a stable income stream. Right, that's what we're looking for, a stable income stream in retirement without needing to exit your investments. The key here is to focus on quality and sustainability of the dividends you're receiving. So when you invest in dividend stocks, especially in sectors influenced by political decisions, you want to look for companies with a strong, committed to maintaining and growing their dividends over time. So one way to identify such companies is by looking at their track record of dividend payments. Companies that are part of the dividend aristocrats, right? For instance, dividend kings, dividend aristocrats, they have consistently increased their dividends for many consecutive years, demonstrating a robust dividend policy that prioritizes shareholders' returns. However, it doesn't end there. It's crucial to analyze where these dividends are coming from. Are they sustainable? Are they paid out of the company's operational cash flow or from their balance sheet reserves? So here's the distinction. Dividends funded from operational cash flow are typically more sustainable. It means the company is generating enough income from its core business activities to cover the dividend payment. On the other hand, if dividends are, say, funded from the balance sheet, it could indicate that the company is dipping into its cash reserves rather than generating enough cash flow from its operations. So ideally, you want to see dividends that are well covered by earnings and operational cash flow. This ensures not only that the dividends are secure in the short term, but also that there's a buffer in case of economic downturns or other challenges. A healthy dividend-paying company should have a payout ratio, dividend payments divided by earnings, that is reasonable and leaves room for future growth and stability. Addressing the timing of when to get out of these investments due to political impacts can be tricky. Now, political events and decisions can indeed affect sectors differently, but for long-term income-focused investors in retirement, the strategy should lean towards maintaining a diversified portfolio of quality dividend stocks. This diversification across sectors and regions helps mitigate the risks associated with any single political event impacting your investments significantly. In summary, rather than trying to time the market based on political fluctuations, that's just guessing. Focusing on companies and investing in companies with a proven track record of dividend payments and robust financial health, right? Monitor the payout ratios, cash flow from operations, and the company's commitment to shareholder returns. So by doing so, you can build a resilient portfolio that generates stable income in retirement, regardless of short-term political noise. Great question. If you would like to send in your question, you can do so by emailing them to poollocke@poollocke.com. And if you like what you heard today, go ahead, like and subscribe to our channel. I'm James Locke, your retirement income source, and I will see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me